Hello, I'm John A.G., and before we talk about silver or markets or numbers, I want you to sit with a feeling most people recognize only after it's too late. It's the feeling you get when something you trusted doesn't fail loudly, but quietly, without drama, without warning, while you're still telling yourself everything is fine. Not panic, not fear, just a slow, creeping sense that the ground beneath you isn't as solid as you assumed, and that the rules you were playing by may have changed without asking your permission. That feeling doesn't come from volatility. Volatility is visible. It announces itself. This comes from realization. The moment you understand that the risk wasn't where you were watching, and that the danger didn't arrive through the front door. It came through a mechanism you barely thought about because it was always described as routine, technical, boring. Something for compliance officers, not for people thinking about long-term value. Markets are very good at training people to focus on stories that feel meaningful, inflation narratives, supply shortages, industrial demand, monetary debasement. These stories aren't wrong, but they can be used as cover. They give people something to argue about while the real leverage sits elsewhere, unnoticed, waiting to be pulled. And when it is pulled, the move looks irrational only to those who never understood what actually controls the system. Here's the uncomfortable truth most people never internalize. Prices don't collapse because everyone suddenly changes their mind. They collapse because someone loses the ability to stay in the game. Forced exits create movement, not opinion. And forced exits don't come from being wrong about the long-term story. They come from being structurally vulnerable in the short term. Leverage is where that vulnerability lives. Futures markets are not ownership markets. They are permission markets. You are allowed to control a large position only as long as you meet conditions set by someone else. Those conditions are not fixed. They are adjustable, discretionary, and enforced without regard for your conviction, your thesis, or your timeline. Margin feels harmless when it's stable. It feels like a formality, a line item, something you account for once and then forget. But margin is not passive. It is the primary control lever in the system. When it moves, it doesn't ask for debate. It demands immediate compliance, and the clock it uses is not yours. This is where psychological disorientation begins. People believe they are managing risk because they've calculated downside based on price movement. What they haven't calculated is rule movement. They assume tomorrow's requirements will resemble today's. They assume the structure itself is neutral. That assumption is the false comfort trap, and it's one of the most expensive beliefs in financial markets. When silver surged and enthusiasm reached its peak, positioning followed the story. Long exposure increased, open interest expanded. Leverage became normalized because recent gains made it feel safe. This always happens near important levels, not because people are reckless, but because success breeds confidence, and confidence reduces perceived risk. That's not a moral failure. It's a structural inevitability. The mechanism that matters appears at exactly this moment. Margin requirements don't rise randomly. They rise when leverage matters most, when positions are crowded, when exits would be painful, when selling pressure would cascade instead of dissipate. Timing isn't accidental, even when it's defended as procedural. Once margins rise, the market stops being a voting machine and becomes a sorting machine. Those who can post additional capital stay. Those who can't are removed, not gradually, not gently, immediately, at market prices, regardless of liquidity. The act of removal becomes the price action. This is where people misunderstand what they're seeing. They interpret the drop as a change in sentiment. It isn't. It's a liquidation sequence. Selling that has nothing to do with belief and everything to do with obligation. And because price is falling during this process, it creates new margin deficiencies, which trigger more selling, which pushes price lower again. The system feeds on itself because it was designed to. Forced selling creates volatility. Volatility justifies tighter risk controls. Tighter controls create more forced selling. This is not chaos. It's feedback. History doesn't warn us because history is dramatic. It warns us because it's repetitive. When similar conditions appear, similar tools are used. Previous silver cycles followed this exact pattern. Initial run-ups driven by narrative, expanding leverage, a margin intervention, a sharp collapse, then another intervention when the market attempts to stabilize, pressure applied until behavior changes. What changes isn't just price, it's participation. Retail traders disappear. Smaller funds reduce exposure. Survivors become cautious. Liquidity thins. The market becomes easier to control precisely because fewer participants remain capable of absorbing shocks. This is where incentives quietly assert themselves. Large institutions with deep balance sheets are not harmed by margin hikes. They are insulated by scale. They can add collateral. They can wait. They can even increase positions when others are forced out. Whether this is coordinated or incidental doesn't change the outcome. The structure rewards those who can endure pressure. Meanwhile, confidence among smaller participants doesn't break all at once. It fractures. People stop trusting their models. They stop trusting the market. They stop trusting themselves. This psychological damage outlasts the price damage, and it alters behavior long after the chart stabilizes. The most dangerous phase comes after the crash, not during it. That's when the market appears calm again. Volatility compresses, prices drift sideways. Commentators declare a reset. This calm is seductive because it feels like resolution, but often it's only an intermission. Control systems rarely act once. They test, they observe, and if behavior hasn't changed enough, they act again. Additional margin adjustments don't need to be dramatic to be effective. In a weakened market, even small changes have large effects. This is the delayed risk most people miss. They assume the intervention was a one-time event. History suggests otherwise. Margin policy is iterative. It responds to positioning, not to fairness. If leverage rebuilds, pressure returns. Understanding this reframes everything. Price stops being the primary signal. Structure becomes the signal. You start watching not just what moves, but what can be moved. You stop asking whether silver should be higher and start asking how much leverage the system is willing to tolerate at current levels. That question is unsettling because it has no moral answer. It only has a procedural one. And procedures don't care how right you are. They only care whether you comply. As we move forward, the most important thing to recognize is that this episode wasn't about silver failing. It was about exposure failing under rule changes. And those rules haven't disappeared. They're still there, waiting for conditions to justify their use again. The real tension now isn't where silver goes next, but whether the structure that governs its pricing has finished applying pressure, or whether this was only the opening move in a longer process designed to reshape who was allowed to participate at all. After the first shock passes, the market enters a phase that feels deceptively rational. Prices stop falling vertically. Volume thins out. Volatility contracts just enough to convince people that equilibrium has returned. This is where the mind fills the silence with relief. The worst is over. The leverage has been flushed. The lesson has been learned. And that belief is exactly what allows the next stage to work. Markets don't reset by eliminating risk. They reset by redistributing it. The traders who were forced out didn't disappear because the thesis failed. They disappeared because they couldn't meet new conditions fast enough. What remains is not a healthier market, but a narrower one. Fewer participants, deeper pockets, different incentives. This narrowing changes how price behaves. With less participation, price becomes more sensitive to smaller flows. Liquidity looks adequate until it's needed. And because many of the weakest hands are already gone, rebounds happen faster than expected. These rebounds are misread as strength, when in reality they're a function of absence. Fewer sellers, not more buyers. This is where leverage begins to creep back in, quietly and rationally. Survivors justify it by pointing to reduced volatility. New entrants justify it by pointing to washed-out sentiment. The narrative shifts from danger to opportunity, and opportunity is the most effective anesthetic in markets. It dulls memory. It reframes pain as tuition. What almost no one considers is that the control mechanism hasn't gone anywhere. Margin policy doesn't expire after one use. It sits idle, waiting for conditions to resemble the ones that justified it before. And those conditions don't require euphoria. They only require enough leverage to matter again. The exchange doesn't need prices to reach previous highs to reapply pressure. It needs positioning to rebuild. It needs exposure to concentrate. It needs risk to become asymmetric. These developments don't announce themselves. They show up in quiet data points that most participants don't track because they don't feel urgent. This is why history matters, but not in the way it's usually presented. The lesson isn't that silver crashed before and recovered later. The lesson is that margin interventions tend to come in sequences. The first shock removes excess. The second ensures compliance. The third, if needed, changes behavior permanently. In previous cycles, this sequence played out over weeks and months, not days. Each time the market attempted to regain momentum, pressure returned in a more targeted form. Smaller hikes, tighter thresholds, less tolerance for volatility. The effect wasn't to destroy the market, but to discipline it. Discipline sounds neutral, even responsible. But discipline imposed externally always favors those with the most flexibility. Large institutions don't experience margin hikes as existential threats. They experience them as friction, an inconvenience, something to adjust around. Smaller participants experience them as binary events. This asymmetry reshapes incentives in ways that aren't immediately visible. When the cost of participation rises unpredictably, only those who can absorb uncertainty remain active. Over time, this concentrates influence. Price discovery becomes less representative, not more, even as it appears more orderly. At the same time, a divergence deepens between financial pricing and physical reality. Paper prices respond instantly to forced selling. Physical markets respond slowly to availability. This lag creates confusion. Observers see falling prices and assume abundance, while participants in physical markets experience tightening conditions. Premiums rise not because demand is exploding overnight, but because supply chains are inflexible. Mining output doesn't adjust daily. Refining capacity doesn't expand on command. When futures prices fall sharply, producers don't suddenly increase supply. If anything, marginal production becomes uneconomic, quietly reducing future availability. Industrial users notice this before investors do. For them, silver is not a trade, it's a requirement. When pricing becomes unstable, procurement strategies change. Inventory buffers increase. Spot exposure decreases. These actions don't move prices immediately, but they reduce responsiveness later. This creates a delayed imbalance. Paper markets signal weakness. Physical markets prepare for scarcity. Both can be true at the same time, but only one can persist indefinitely. The longer this divergence lasts, the more strain it places on the assumption that a single price represents reality. Financial participants, meanwhile, become conditioned by recent pain. They reduce time horizons. They trade more tactically. They demand confirmation before committing. This behavior suppresses rallies and reinforces the appearance of control. The market feels contained, even as underlying tension accumulates. This is where second-order effects begin to matter more than first-order ones. It's not the initial margin hike that defines the cycle. It's the behavioral residue it leaves behind. Reduced trust, shorter patience, lower tolerance for drawdowns. These shifts change how the market responds to new information. When another policy signal appears, it doesn't need to be dramatic to be effective. It only needs to arrive when confidence has partially returned. That's when positioning is most vulnerable, because participants believe they understand the risk again. This is the mid-cycle cliffhanger most people miss. The danger is no longer visible stress, but invisible assumption. The belief that the system has shown its hand and therefore won't act again in the same way. History suggests the opposite. Control mechanisms rarely reveal their full range on the first use. The practical reframe here isn't tactical timing, it's understanding optionality. Leverage removes optionality by imposing deadlines. Ownership preserves it by allowing time. This distinction becomes critical when policy, not price, drives outcomes. None of this requires believing in conspiracy or coordination. It requires understanding incentives. Exchanges are incentivized to reduce volatility. Clearing members are incentivized to limit risk. Institutions are incentivized to protect capital. These incentives align naturally in ways that disadvantage those without flexibility. As this phase continues, the market will offer mixed signals, periods of calm interrupted by sharp moves, rallies that stall unexpectedly, declines that feel excessive. Each event will be explained individually, but the pattern will remain consistent. The unresolved question now is not whether silver will stabilize, but what kind of market will exist when it does, broad and resilient or narrow and controlled, responsive to fundamentals or hypersensitive to policy. Because the next shift won't come when fear is highest. It will come when attention has moved on, when narratives have cooled, and when most participants believe they've already survived the worst. By the time a market reaches this final stage, the real damage is no longer visible on a chart. It lives in expectations. People stop expecting fairness. They stop expecting continuity. They stop expecting price to behave as a reflection of reality. Instead, they begin to treat it as a managed outcome, something provisional, something that can be altered without notice. That shift is subtle, but it's irreversible once it takes hold. This is where confidence doesn't collapse, but decays. Not everyone leaves at once. Participation thins gradually. Long-term thinkers retreat into structures that don't demand daily validation. Short-term actors dominate what remains. The market becomes louder but shallower, more reactive and less representative. On the surface, everything still functions. Underneath, resilience has been quietly traded for control. The most persistent misconception at this point is that intervention has solved the problem it was responding to, that leverage has been dealt with, that excess has been removed. In reality, intervention only changes the location of stress. It pushes it out of visible pricing and into less transparent corners of the system, where it accumulates without attracting attention. This is especially true in markets with both paper and physical expressions. When futures pricing becomes unreliable as a signal, participants who actually need the asset stop trusting it. They hedge differently. They stockpile. They sign longer contracts. None of this shows up immediately in spot prices, but it changes the future landscape in profound ways. Physical availability doesn't disappear overnight. It tightens unevenly. One region experiences delays. Another sees rising premiums. A third quietly runs inventory lower than usual. These are not dramatic events, which is why they're ignored, but they are cumulative. And once physical markets begin operating defensively, elasticity disappears. At that point, price loses its ability to smooth imbalances. Small disruptions create outsized reactions. What once would have been absorbed now propagates. This is how systems snap after long periods of apparent calm, not from sudden demand spikes, but from an absence of slack that nobody realized had vanished. Meanwhile, financial participants continue adapting in the opposite direction. Scarred by forced liquidation, they prioritize flexibility over conviction. Positions are smaller, time horizons are shorter, rallies are sold more aggressively. This behavior suppresses upside and reinforces the illusion that control is working, but control always carries a cost. The more a system relies on policy to maintain order, the more fragile it becomes when policy is constrained. Margin hikes can slow a market. They cannot create supply. They cannot resolve structural demand. They can only delay recognition. This is where the deepest risk sits and has nothing to do with price targets. It's the risk of misalignment between what the price suggests and what the system can actually deliver. As long as confidence bridges that gap, the market functions. When it doesn't, repricing isn't optional. It's forced. History shows that these moments don't arrive with warnings. They arrive after long stretches of boredom, after narratives have faded, after the asset has been written off as uninteresting or controlled. That's when pressure is greatest because attention is lowest. The practical framework here is not about prediction, it's about survivability. Structures that require permission to hold exposure are vulnerable to rule changes. Structures that rely on ownership are not. This distinction doesn't eliminate volatility, but it determines whether volatility is something you endure or something that removes you. What makes this uncomfortable is that there's no clean signal for when the balance tips, no indicator that flashes red, only a series of small frictions that, taken individually, seem manageable. It's only in retrospect that they appear connected. As confidence erodes, trust migrates, away from centralized mechanisms, toward forms of control that don't depend on compliance. This migration is slow, uneven, and largely invisible until it reaches a threshold. Then it accelerates, not because people panic, but because they stop believing in the old framework. The unsettling reality is that systems built on leverage require constant confidence to function, while systems built on ownership require only time. When confidence becomes conditional, leverage becomes fragile. And fragility doesn't announce itself until it's tested. So the final question isn't whether silver will rise or fall next. It's whether the structure governing its price can continue to substitute control for trust without consequence, whether repeated interventions strengthen the system or quietly hollow it out. Because if this cycle has revealed anything, it's that the most dangerous assumption is not that markets are manipulated, but that they will always give you time to react. And history suggests they rarely do.